Welcome to the April Market Thoughts video. My name is Maria Considine King, and I'm joined by Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Brad, before we jump in, can you talk with us about the three main factors that influence markets in March?
There are a bunch of things going on, and most of them are good, but I think the three biggest ones here were, first of all, consumer spending, which came in quite strong. It's actually not as good as the headline figure would suggest, but still quite strong. The second is employment, which continues to exceed expectations and to do quite well. You saw upward revisions for the first 2 months of the year, as well as a strong March figure. And then you have the situation in Europe, which seems to have calmed down. Now, you can make a good argument, and I would make that argument, that it's not as calm as it looks, but nonetheless, the perception in the market is that the crisis there is starting to be resolved. So given the strong performance of the U.S. economy, the strong performance of employment and spending, and the lower risk environment, it's no surprise to see strong market results.
Given those major influences, how did markets perform last month?
March was a great end to a great quarter for the U.S. All major indices were up substantially. The first quarter was the strongest since 1998. And typically, if you look at years where the first quarter's been in excess of 7%, typically the rest of the year has been very strong. You know, typically I think it's 7 of 8 of those years in the post-war period have been positive at the end of the year by an average of almost 8%. The cautionary tale there, of course, is that also includes 1987, where the remaining 9 months had a minus 15% return. So we're not out of the woods, but certainly the U.S. markets have done well and can reasonably be expected, based on history, to have a reasonable probability of continuing to do well. International markets didn't do so well. You're starting to see Europe slow down. You're starting to see some of the other markets out there slow down. So the international markets, the international indices, actually ended up closing down marginally. They had a strong first quarter, but they did not do as well. Bonds are kind of chugging along for a broad portfolio of bonds. High yield did well in the first quarter, and that's something that it'll be interesting to see if it continues.
Brad, do you have any concerns that recent equity market gains may have skewed valuations at all, or do you think that they are reasonably priced?
It really depends on what metric it is you're looking at. You have a situation where the shorter term metrics, the trailing 12-month Ps, the going forward 12-month Ps, suggest the market is indeed reasonably priced. And I think those are valid metrics. However, those are based on current profit margins, which are at very, very high levels historically. So whether those indicators are valid really depends on the sustainability of corporate profits at the current level. And that's kind of an open question. If you look at longer term indications, like for example what's called a Shiller P ratio or a Q ratio, the markets do indeed seem to be pretty overvalued. So again, you can make an argument both ways. I place more reliance on the longer term value indications, which suggests that the markets may have gotten ahead of themselves.
In spite of persistently low interest rates, companies don't seem overly compelled to pull cash off of the sidelines and invest it in payroll. Do you see that dynamic shifting at all in the coming months?
The rubber is really going to hit the road over the next couple of months on that one. Productivity has been dropping as companies have pushed existing employees more and more. And you've seen that actually in the hiring trends, which, as I've said, are quite positive and going up. Now, we've been in this situation for the past 2 years at the end of the first quarter, and so companies will now have to make that decision again. Are they going to continue to expand production and therefore continue hiring, or are they going to say, we don't believe that the sustainable expansion is here yet? If you look at consumer spending trends, and if you look at some of the wage-driven spending trends, I believe that we are at a point where that is sustainable. So I suspect that employment will continue strongly, but that's very much an open question. That's something we're going to be watching closely over the next couple of months.
Thank you, Brad.
Thank you, Maria.
And thank you. Please join us next month for the Market Thoughts video.